Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Modern Dental Group Limited annual report. Modern Dental Group Limited offers a wide range of businesses and services across various segments. The company's primary focus lies in the production, distribution, and trading of dental prosthetic devices globally. The fixed prosthetic devices segment involves the creation of crowns, bridges, and implants for restorative dental procedures. This includes full and partial dentures with and without metal frameworks. In addition to these products, Modern Dental Group Limited also produces orthodontic devices such as sports guards and anti-snoring devices. Furthermore, the company offers raw materials and clear aligners, catering to the needs of dental professionals worldwide. The removable prosthetic devices segment is another key area of focus for the company, with a range of products designed for patients requiring removable dentures. In terms of services, Modern Dental Group Limited provides educational events and seminars for dental professionals. This not only enhances their knowledge, but also fosters collaboration among industry experts. The company's diverse product portfolio is sold under various brands, including Labicast, Permadental, Elise, Yangzhajing, Modern Dental Laboratory, Modern Dental USA, and Southern Cross Dental. Overall, Modern Dental Group Limited has established itself as a prominent player in the dental prosthetic devices market, offering a comprehensive range of products and services to cater to the needs of patients and dental professionals alike. Modern Dental Group Limited maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Modern Dental Group Limited trades at a lower price-to-earnings ratio of 12 times and a higher price-to-book ratio of 1.74 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 4.89%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth in the dental industry can be attributed to several key factors. Firstly, companies are adopting multidimensional strategies and operational efficiency enhancements to boost productivity and reduce costs. The digitalization trend is also contributing significantly to revenue growth, as more patients opt for digital dentures and other innovative products. Consolidation within the industry has led to increased market share and revenue growth. Additionally, double-digit revenue growth in Europe and Australia, coupled with the launch of new products and strong uptake of digital products, have all contributed to overall revenue growth. The acquisition of Hexa Ceram Company Limited and Digital Sleep, Australia, has also provided a significant boost to revenue. Furthermore, state-of-the-art digital workflows and continued organic growth in key regions have solidified market position and driven revenue growth. Overall, these factors have combined to drive revenue growth across the industry. On the other hand, primary drivers of revenue decline include prolonged intense price competition in Greater China, softness in the North American market, and depreciation of the Australian dollar against the Hong Kong dollar. Volume-based procurement policies in mainland China and aggressive promotions for dental implant treatments by clinics in Hong Kong have also contributed to revenue decline. Additionally, soft demand for discretionary cosmetic treatments and implementation of U.S. tariffs have further impacted revenue growth. Net income experienced significant fluctuations over the period in question. Initially, it rose by a substantial 47.7% from HK 406 million $943,000 to HK $601,249,000. However, this upward trend was disrupted by headwinds in the mainland China market, leading to a decline in net income. Despite this setback, net income rebounded with an increase of approximately 11.1% to HK $3,736,519,000. Profit margins also underwent changes during this period. The gross profit margin saw a notable rise of 2.3%, increasing from 53.5% to 55.8%. This upward trend continued, reaching 56.8% after an additional increase of 3.6 points. However, not all product categories experienced growth in their respective gross profit margins. For instance, the gross profit margin for removable prosthetic devices decreased from 54.9% to 54.1%, while that for fixed prosthetic devices increased from 55.1% to 58.1%. The gross profit margin for others also saw an increase from 44.7% to 49.9%. The varying changes in net income and profit margins can be attributed to a combination of factors, including market conditions and product-specific performance. The company's financial performance is a key indicator of its overall health and sustainability. A review of the operating cash flow reveals that the company is generating positive operating cash flow. This is evident from the data provided on page 9, which shows an increase in net cash from operating activities from $1,245,119 in 2024 to $1,421,819 in 2025. Furthermore, as stated on page 54, the company's operating cash flow is indeed positive, with a specific amount of HK $763,102,000. This indicates that the company has sufficient liquidity to meet its financial obligations and invest in growth opportunities. Overall, the data suggests that the company is generating positive operating cash flow, which is a crucial aspect of its financial performance. The company's debt level has undergone significant changes over the past period. Initially, total debt decreased from HK $115,910 to HK $70,882 on page 9. This trend continued with a substantial decrease of 34.5% in non-current interest-bearing bank borrowings on page 26. Furthermore, the total debt reduced from HK $737,151 to HK $478,245 on pages 27 and 55. These changes indicate a notable reduction in the company's debt level. In terms of interest expenses, there has been a significant decrease from HK $42,107,000 to HK $25,090,000 on page 54. This change is attributed to fluctuations in interest rates, as mentioned on page 61. The shift from HIBOR plus 0.725% to HIBOR plus 1.6% in 2024, and then to HIBOR plus 0.65% to HIBOR plus 0.8% in 2025, has resulted in a substantial reduction in interest expenses. The performance of various segments in the industry has been analyzed. On a positive note, fixed prosthetic devices have shown improvement with a revenue increase of $156,667 and a corresponding gross profit rise of $152,476. In contrast, removable prosthetic devices have struggled, experiencing a decline in both revenue and gross profit by $117,015 and $57,361 respectively. The others segment has seen an increase in revenue, but its gross profit growth is not substantial compared to other segments. Management is emphasizing the company's commitment to growth and innovation through strategic partnerships and acquisitions. They aim to expand their product offerings by selectively pursuing joint ventures, partnerships, and acquisitions that complement their existing networks. This multidimensional approach will enable them to remain at the forefront of the industry. The management believes that Dr. Chan's leadership is crucial in driving consistent leadership and effective strategic planning. With his guidance, the company can navigate complex market dynamics and make informed decisions about future growth opportunities. By leveraging partnerships and acquisitions, the company plans to expand its reach and solidify its position as a leader in the industry. The company has a history of paying dividends to its shareholders. In 2025, the proposed interim and final dividends are set at $129,029 and $140,228 respectively. Similarly, in 2024, the company paid out $75,752 as an interim dividend and $86,855 as a final dividend. These figures indicate that the company has consistently distributed a portion of its profits to shareholders through dividends. Concerns about inventory buildup and supply chain disruption are evident in recent data. On page 7 of the report, it is noted that inventory costs have increased by $420 from 2024 to 2025. This significant jump suggests that companies may be struggling to manage their inventory levels effectively. Furthermore, on page 60, trade disputes and protectionist measures are highlighted as major disruptors to international commerce and supply chains. These disruptions can lead to delays, increased costs, and reduced efficiency in the delivery of goods. As a result, businesses must navigate these challenges carefully to avoid further complications. That concludes the financial summary for Modern Dental Group Limited. Feel free to comment below, and I will be happy to answer them when possible.